Hello traders, welcome back to my channel. In today's video, we'll be covering an essential concept in forex trading, which is what is a pip and how to calculate it. Now let's dive in. First thing first, what exactly is a pip? A pip is just an abbreviation which stands for percentage in point or price interest point. It is the smallest standard unit of price movement in a currency pair. In most currency pairs, a pip is the movement in the fourth decimal place of the exchange rate. So, if real USD moves from 1.1200 to 1.1201, that's a movement of 1 pip. However, there is an exception to this with currency pairs that involves the Japanese yen, that is JPY. In this pairs, a pip is the movement in the second decimal place. For example, if USD JPY moves from 110.20 to 110.21, that's a movement of 1 pip. Now let's briefly talk about pipette. Some brokers display quotes to 5 decimal places for most currency pairs or 3 decimal places for Japanese yen pairs. The extra decimal place is called a pipette. For example, if Euro USD moves from 1.12005 to 1.12015, that's a movement of 1 pipette or 0.1 pips. So, while pips are the standard measurement, pipettes offer a more precise way to measure price movement. You can calculate pips manually like I showed you how to do it, but it will take your time. Maybe whenever you want to place a trade and you're about to calculate the pips manually, you might miss out on the trade. So that's why there is a tool in trading view that allows you to calculate the amount of pip you are risking and the amount of pips you are targeting. So the name of the tool is long and short position tool in trading view app. So there is no need bothering yourself on how to calculate the pips manually. Now let's talk about why pips are important. The number one reason why pip is important is what? Measuring profit and loss. Pip are the standard unit of measurement for determining how much you have gained or lost in a trade. Every pip movement affects the balance of your account based on your trade size. Number two reason why pip is important is setting stop losses and taking profit. When you are setting your stop loss or taking profit levels, you are doing so in pips. Understanding pip calculations helps you to manage your risk and optimize your reward. Then the number three and the last is what? Comparing spreads. Spread is the difference between the ask price and the bid price. It is the amount that is being charged by the broker for placing a trade for you. So here, comparing spread, the spread, which is the difference between the bid price and the ask price, is usually measured in pips. A tighter spread, that is a fewer pips, means lower trading cost, while a wider spread means higher cost. That's a wrap up for today's video. If you found this video helpful, make sure to like the video, subscribe to my channel and hit the notification bell so you don't miss any of my upcoming forex trading tutorials. Also drop a comment if you have any question about pip calculation or anything else you want me to cover in the future videos. Thank you for watching.